Hello and welcome. Today, we're diving into the world of macroeconomic forecasting. What is it? Simply put, it's the attempt to predict the future health of an economy. Things like growth, inflation, unemployment, and interest rates. Think of it as an economic weather forecast. It's vital for governments making budget plans, central banks setting interest rates, businesses deciding whether to expand, and even investors choosing where to put their money. But here's the catch. It's often called more of an art than a science. Perfect prediction is impossible, but forecasting gives us a data-backed glimpse into potential economic futures, crucial in our complex world shaped by tech changes, global tensions, and even climate concerns. So how do economists try to predict the future? They use a toolbox of techniques. One major category is econometric models. These use economic theory and statistics to map out relationships between variables. Some are complex structural models, trying to mirror the economy's deep workings, like those used by central banks. Others are reduced form models, focusing more on statistical patterns, like the VAR models that look at how different economic indicators influence each other over time. Then there are purely statistical time series models, like ARIMA, which look for patterns in historical data without relying heavily on economic theory. They're good at capturing trends and seasonal effects. Another technique involves leading economic indicators. Think stock market movements or building permits, things that tend to change 20 before the broader economy does. Of course, we can't ignore the rise of machine learning and AI. These tools can sift through massive datasets, even social media sentiment, to find complex patterns traditional models might miss. Forecasters also gather expert opinions through surveys and create consensus forecasts by averaging many predictions. Sometimes, it's a less formal checklist approach, assessing various factors. Often, the best strategy is a hybrid one, combining multiple methods to get a fuller picture. Why go through all this effort? Well, these forecasts have huge real-world applications. Governments use them for budgeting and designing tax or spending policies. Central banks rely heavily on them to manage inflation and growth by adjusting interest rates. Businesses use forecasts to plan investments, production, and hiring. For investors, forecasts help shape strategies and manage risk in financial markets. They also allow for what-if scenarios, simulating the impact of potential shocks like oil price surges or policy changes. Now, let's be realistic. Macroeconomic forecasting is incredibly challenging. Economic models have to simplify a vastly complex reality, often making assumptions that aren't always true. The data used can be delayed, revised, or just plain inaccurate. And critically, forecasts struggle with the unexpected: pandemics, wars, financial crises. These events are hard, if not impossible, to predict. Human behavior, driven by sentiment and psychology, is also tricky to model. Add to that the uncertainty around future government policies and the fact that the economy's underlying structure can change over time, making historical data less relevant. Forecasts are probabilities, not certainties, and they've historically struggled to predict major turning points like recessions accurately. In conclusion, macroeconomic forecasting is essential but imperfect. Techniques are getting more sophisticated, especially with big data and AI helping us get faster, more detailed insights. However, the fundamental challenges remain. Models are simplifications, data isn't perfect, and the unexpected happens. Recognizing these limits, using multiple approaches, and applying expert judgment are key to using forecasts wisely. They aren't crystal balls, but they are vital tools for navigating economic uncertainty and making better decisions in an ever-changing world. Thanks for tuning in.